At the end of this video, you will find out how to use moving averages to improve your trading strategy. Welcome to 4S Trader, where we give you the secrets on how to beat the forex market. If you want to learn how to grow your trading account, make sure to subscribe to the channel by clicking the subscribe button below this video and turning on the notification bell so you don't miss any of my new videos. In 2014, I had no idea what forex was. At that time, I was scrolling through Instagram and I saw some of my friends post that they were trading this so-called market called forex. It looked like stocks, but it wasn't stocks. I got curious and asked them, hey, how can I learn more about this? And they introduced me to the local forex trading group and I joined them. Then they taught me some of the basics of forex that I know today. At that time, after I joined, one of the first trading indicators that they taught me was the moving averages. Although I have left the group for a long time, moving averages is still one of the core components of every trading strategy that I use today. And the reason is moving averages is a very powerful indicator. So now let's go through what we will be covering in this video. Number 1, why use moving averages? Number 2, what are moving averages? Number 3, how to use moving averages. Without further ado, let's begin. Why should we use moving averages? What benefits can it give us? So let's look into that right now. The first benefit that moving averages can give us would be that it removes noise. The market is full of noise. The reason behind this is because price does not move in a straight line. Prices move up and down, up and down. With the naked eye, most of the time it can be a bit hard to tell whether the price is on an uptrend or a downtrend. The solution to that would be to use moving averages. Moving averages can actually help us find that middle point of the line to let us know whether the price is on an uptrend or a downtrend. Number 2, support and resistance. A lot of people like to use moving averages to find their support and resistance levels. And the reason behind this is because moving averages is a very popular indicator, which means a lot of people around the world will be watching the same levels. This causes a lot of supply and demand when prices is near the moving averages. So a lot of people will be using these levels to calculate their stop loss and their take profit, and you can do the same. So let's move on to part 2 of this video. What are moving averages? Moving average is the average of the closing prices of the last X number of candles. By saying this, you might not be clear on what moving average is, so let me give you an example. Let's do an example with the 5 moving average. Now, these are the 5 closing prices of the last 5 candles, 4, 2, 4, 2, 3. Now what we want to do is to add them all together and divide it by the number of periods. Since we are using the 5 moving average, therefore the number of periods will be 5. So you take the total and divide it by the number of periods and you will get 3. This is how you calculate the 5 moving average. Now let's do another example with a 20 moving average. Let's make it simple and just put 2 as the closing price of the last 20 candles. Now what we want to do is we want to add the closing prices of all these 20 candles together and divide it by the number of periods. Therefore, by adding all these numbers together, it will be equal to 40. Number of period that we will be using is 20 because we are using the 20 moving average. Now you divide 40 by 20, you get 2. Then this is how you calculate the 20 moving average. This is just for your information and you don't have to remember this because the indicator will calculate it for you. That's why we use the moving averages. A question that I get asked a lot is that will moving average levels stay the same when I change time frame? And the answer is no, because you have to remember moving averages are calculated based on the last X number of candles on that specific time frame. Let me make it clear for you. On the 1 hour chart, if you are using a 5 moving average, you'll be taking the last 5 1 hour candles to calculate the moving average. However, if you are on the 4 hour chart, you'll be taking the last 5 candles of the 4 hour time frame to calculate the moving average. And that is why when you are changing time frames, you will notice that the moving average levels will actually change. How many types of moving averages are out there? The 2 most common type of moving averages, and the only 2 that we will be talking about today, is a simple moving average and the exponential moving average. The simple moving average is based on the calculation that I showed you earlier. The difference between the simple and exponential is the exponential puts more emphasis on the recent prices. So now let me show you a clearer picture on how this works. Let's talk about the difference between the exponential moving average and the simple moving average. The simple moving average is based on the calculation that we have done earlier, adding all the numbers and dividing it by the number of periods. However, in exponential, more weight will be given to the recent prices. Let's do an example. 42423 are the prices of the exponential moving average, and 2 and 3 are the latest prices. Therefore, an exponential moving average gives more weight to 2 and 3 in its calculation. Now let's go on to see the pros and cons of the simple and exponential moving average. Let's talk about the pros and cons of the exponential moving average. Since just now we have talked about exponential, the only difference is that it gives more weight to recent prices. So what effect does this have? The pros of exponential would be it reacts faster to price changes. If there's suddenly a new trend, exponential will give you the opportunity to catch that trend earlier than using the simple moving average. However, the cons would be it will be sensitive to fake outs. What are fake outs? For example, suddenly you have this big candle that breaks out and you thought that it's a new trend because it crossed the moving average, because the moving average is showing there's a new trend. However, that is not the case, because the next candle everything retraced and the trend went the other way. Alright, this is called a fake out, and the cons of using an exponential moving average would be it would be sensitive to fake outs. Now let's talk about the pros and cons of simple moving average. Basically, the pros and cons is just the opposite of the exponential. In the exponential, in the cons you have it's sensitive to fake outs. However, in simple moving average, it removes all the fake outs. And the cons of the simple moving average would be it reacts slower to price changes, where the exponential reacts faster to price changes. I hope this gives you more insight on how to choose which moving average to use in your trading strategy. If you like the content of this video so far, feel free to click on the like button below this video and subscribing to the channel if you would like to learn more about trading and how we can beat the markets together. Now let me share with you the most commonly used levels of moving averages. For the short-term trend, the most common level would be the 20 moving average. For the medium-term trend, the 50 and the 100 is commonly used. And for the long-term trend, we use the 200 moving average. All of these levels can actually help us determine the trend. Most of the time, I have 2 to 3 different levels of moving averages on my chart. I personally use the 50 and the 200 the most often. And sometimes I even use the 20 when I'm actually scalping the markets or I'm day trading. And I will be using exponential moving averages instead of simple moving averages. And the reason behind it is I personally think that there is not much of a difference between using the simple moving average and the exponential moving average. So now let me show you how to implement what we have learned. I will be using TradingView in this example. TradingView is the charting platform I use. I prefer to use TradingView over MetaTrader 4 when I'm charting, since there are more features and my charts are synced over multiple devices. Anything that I do on my computer, it will be synced to my phone. If you are not on TradingView yet, you should definitely try it out. I'll leave a link in the description box below. Now let's get started. Now just open your chart and click on indicators on top here. Alright, now once you have clicked indicators, what you want to type in is exponential moving average. If you want to find a simple moving average, just type in simple moving average. For this example, we will be using the exponential moving average. We want to choose the one that is built in TradingView for our example. Just click on the one at the built-in. Once you have inserted the moving average into your chart, you can adjust the settings by going to the top here, press on settings, and you can change any details that you want, from the color to the length of the EMA. In this example, we will be using the 200 EMA. Now, normally for the 200 EMA, I prefer to put it as red. Alright, now it's a personal preference, but I prefer to have my lines thicker because it's more easier to see. Just click on the color again. At the bottom, you can select the thickness that you want. I tend to go for the medium. Now our chart looks better. Without the moving average, it's hard to determine a trend because there is a lot of noise from the price. Once you have the moving average, the trend becomes more clearer. For moving average, you have to remember this. Price is on an uptrend Price is on uptrend when the price is above the moving average. When it crosses the moving average and goes below, it becomes a downtrend. We only want to look for buying opportunities when the price is above the moving average. And we want to find selling opportunities when the price is below the moving average. Something to note is that the 200 EMA is a long-term trend. Most of the time, I have more than one EMA on my charts. Let's try inserting a few EMAs. Now, just same thing, exponential moving average. Alright, now we go to settings and I want to put it to 50. I personally prefer the blue color and put it at the medium thickness. Now the 50 EMA is normally what determines the medium term trend. It acts as an additional filter. When the medium term moving average tells you that it is a downtrend and the long term moving average tells you it is also a downtrend, it has a higher possibility the downtrend is a strong downtrend. Thanks for watching this video, and I hope you enjoyed and actually learned something from the video. This video is just an introduction for newer traders and people who don't really use moving averages. If you would like to watch my next video, make sure you click on the subscribe button below and turning on the notification bell so you don't miss anything. I'll see you in my next video.